This is a video explanation on limited company accounts. The question is from SQA Advanced Higher 2012. Okay, let's have a look at the question. So as you can see, that's the trial balance of Carlook PLC as at 31st December year 3 after the preparation of trading account. So in this trial balance, you won't see any sales, any opening inventories, or anything that is required in order for you to find the gross profit, because in the question, the trial balance is the one after the preparation of trading account. So in this trial balance, you have gross profit calculated for you, which is given in your trial balance. Okay, and on top of that, as you can see, you don't see any opening inventories in the trial balance. Instead, you have the closing inventory in the trial balance. Okay, let's go through the items in your trial balance. You have the preference shares. So 200,000 is in units. This 200,000 on the here, the one that I underlined in red, is your amount in units. The 8% represents the dividends paid, and each of the unit is £1 each. So 200,000 times £1 will give you £200,000 in value. As for the ordinary share, it's 300,000 units at 50 pence each, which will give you 300,000 times 50 pence is 150,000. Okay, and then you have debentures. So debentures, 10% is your interest. 100,000 is the value of your debenture. So from here, you'll be able to find your interest on debenture. And then we have gross profit. So as I've mentioned earlier, since this is the trial balance after they have prepared the trading account, so they have already calculated your gross profit. So in your statement of profit or loss or your income statement, you will start off your SOPL with the gross profit amount. You will skip the sales minus cost of goods sold. Later I will show you how it's done. And then we have the closing inventory. So instead of having your opening inventory, normally you see opening inventory in your trial balance. But again, since this is the trial balance after your trading account has been prepared, so therefore you don't see any opening balance. Instead, you have your closing stocks. Which is 13,000. And then office expenses is an expense. Discount, advertising, those are all your expenses. So discount here can either be an expense or revenue, depending whether the amount is on the debit or credit side. So as you can see here, it's on the debit side. So if it's on the debit side, it's an expense. So this would be your discounts allowed. Okay. Provision for doubtful debts at 1st January year 3. So this is your opening provision, which is 1,000. And then you have your debtors, creditors, bank. So bank is on the credit side, so that's your overdraft. Interim preference dividends paid, interim ordinary dividends paid, this is the amount that has been paid, so that will affect your profit. Share premium is your equity. Long-term investment is a non-current asset. This is when the company invests in other companies, so it's considered as their non-current assets. VAT, value added tax, you can either be current asset or current liability, depending on whether it's on the debit or credit side. So now, what is VAT? VAT or value added tax is when a business owes tax to the company and the customers owe tax to the business. So it depends on whether the amount that the business owes to the company is higher or lower than the amount that the customers owes to the business. Okay, so if, say for instance, the business the customers owes to the business more than what the business owes to the company, then it will be a current asset. So in this question here, in order for you to determine whether VAT is a current asset or current liability, you need to see whether it's on the debit or credit side. So here is on the debit side, therefore it's a current asset. Oh yeah, by the way, if you look at the one that is handwritten on this question, these are all the workings, okay, which I will explain to you in a minute. Profit and loss account balance at 1st January year 3. So this is the P&L or your profit from previous year, okay, that's carried forward to this year. Okay, premises, fixtures and equipment, vehicles, these are all your non-current assets at cost. And provision for depreciation, this is your accumulated depreciation, 70 and 18,000 for fixtures and equipment and vehicle that you have to deduct from your cost amount. Right? Goodwill is your non-current asset, intangible non-current asset, as I've explained in the lecture. Preliminary expenses, okay, is the one that I've mentioned before, that this will not be seen in any of your statements. Instead, this preliminary expenses will be deducted from your equity, one of your equity. Okay, so I'll explain to you further when we come to the calculation. Right, so you have all the notes here. So marketing value of closing stock is 15,000. Okay, now let's look at your stocks in your trial balance. Okay, the stocks in your trial balance is 13,000. The market value, so this 13,000 here represents the cost price. Okay, the market value of the closing stock is 15,000. So when it comes to your statements, okay, you should take whichever value that is lower, right? So as you can see here, 13,000, which is the cost, is lesser than the market value, which is 15,000. In your records, you have to choose the lower amount. So you will record the 13,000 instead of 15,000. Why? Because this is in accordance to prudence concept. So you would have learned prudence concept in semester 1, whereby prudence concept states that you do not want to overstate your assets and your revenue. So in this case here, you do not want to overstate your assets, so that's the reason why you take the lower value. And also you do not want to understate your expenses and liability, right? So basically that is your prudence concept. So as you can see here at the bottom, number 1, closing inventory, we take 13,000 as the value. Number 2, office salaries accrued are 2,000. So accrued here means that you have yet to pay. Okay, so you have yet to pay, you still owe the 2,000 office salaries. However, this office salaries has incurred. So what you need to do is the office salaries in your trial balance. Let's see whether there's any. No, there's office expenses. There's no office salaries. Okay, so office salaries here is something that has not been recorded yet in your trial balance. So therefore, the office salaries is considered as your accrued expense that will be recorded in your SOFP as your current liability, right? And at the same time, the office salary will also be recorded as your expenses in P&L. Okay, so you need to record it in your income statement or statement of profit or loss, and also in your balance sheet or your SOFP as your current liability. So both, right? There's 2 treatments there for this office salaries. Number 3, figure for advertising includes the payment for the first quarter of year 4. So this means what? Okay, so this advertising, right, covers the 10,000 here, covers not only for year 3 but also first quarter of year 4. Okay, so if it covers first quarter of year 4, then it will be 1 over 5. In one quarter, there are in 1 year there's 4 quarters. Okay, in 1 year there's 4 quarters. Sorry about that. Okay, so if they say that they paid it also covers the first quarter of year 4, then meaning that the figure 10,000 covers for 5 quarters. Okay, so the 5th quarter is for the next accounting period, which means that the 1 out of the 5 quarters has to be removed, okay, from your advertising amount. That is considered as your prepaid. Okay, so here you have your calculation. Okay, it's 1/5 times 10,000. There's a mistake here, so it becomes 2,000. So this 2,000 here, this 2,000 here is considered as your current asset, yes, because it's your prepaid expense, and this 2,000 has to be removed from the 10,000. Okay, so it becomes 8,000 only that you'll record as your advertising expense. Okay, later when you see the answer, then it'll be you can see how it's recorded. Yeah. Right. Next, provision for doubtful debts to be increased by 2,000. So your provision for doubtful debts, originally it was from last year. Yeah, let's look here. It was 1,000. Okay, it was 1,000. This is from year 1st January year 3, meaning that it's from your year 2. So the new AFDD or the new provision for doubtful debts is 2,000, meaning that there's an increase of 1,000. Sorry, here is to be increased by 2,000. Yeah, so meaning that the new AFDD is 3,000. So you need to add on the 2,000 to your 1,000 to get your new AFDD. Yeah, so there's an increase in AFDD by 2,000. The increase in AFDD is considered as your expense in your SOPL. The new value 3,000 will be deducted from your debtors in your SOFP. Okay. Right. Next, depreciation. Depreciation for fixtures and equipment is 20% of the reduced balance, whereas for vehicles is 10% on cost. So reducing balance method you need to take your percentage and multiply with your net book value. This is something that you should have learned last semester. Okay, so fixtures and equipment, let's look at fixtures and equipment. You have the one at cost is 150,000. Your provision for depreciation, okay, from 1st January year 3 is 70,000. Okay, so it's 150,000. You can see the workings down here. 150,000 minus 70,000, so that's 80,000 times 20%, you get 16,000. So you need to use the net book value. What is the net book value? Is the cost minus your provision for depreciation from last year. Okay, so that's what they call as reducing balance method. Whereas for vehicles is 10% on cost. So you simply take the vehicle at cost, which is 90,000 times 10%. So you get 9,000. So this depreciation is considered as your expense in SOPL, whereas this expense here has to be added on to your provision for depreciation amount to be deducted from your fixtures and equipment at cost and vehicles at cost in your SOFP, right? Corporation tax is 25%, so this has to be multiplied with your profit, okay, which will be shown later in your SOPL. Write off the preliminary expenses by transfer from the share premium account. So as I've mentioned, preliminary expenses will not be recorded anywhere in your statements, but instead you will have to minus it out from your share premium account because it's transferred from the share premium account. So it will reduce your share premium account. So your share premium, originally the amount was 75,000 in your trial balance. Okay, so you need to minus out 30,000 because preliminary expenses is 30,000. So you minus 30,000 there. Okay, right? For this part here, I will explain in a minute. Okay. Premises were professionally revalued at 295,000, with the surplus on revaluation being transferred directly to a reserve account. So this is your revaluation reserve. So premises, the original cost is 280,000. Okay, premises at cost. So now the value has increased to 295,000. So there's an increase of 15,000. So you can look down here, there's an increase of 15,000, is called as revaluation reserve under equity. When you record your premises in your non-current assets, you would record it based on the revalued amount, which is 295,000. Okay, and number nine is a proposed. Okay, it's a proposal. The directors propose to pay final ordinary dividend, pay preference dividend, write off goodwill. These are all proposals. So proposal you ignore, okay, because it has not happened yet. So this will be put under notes to the accounts if you want to. There's no need if the question did not ask for it. Number 10, dividends 10% are due on long-term investment. So dividends, if you look at your trial balance, there's 10% debenture. So 10% times 100,000, that will give you, oops, sorry. Oh no, sorry, yeah. This is dividends of 10% due on long-term investment. Sorry about that. So long-term investment, just now is your non-current assets, 150,000 times 10%, you get 15,000. So this 15,000 is the dividends that you received from your investment. So it's considered as your revenue. Okay, 15,000. And this 15,000 is also considered as your accrued revenue, which will be recorded as your current asset because you have not received it yet. Okay. Number 11. Bonus issues of 50,000 ordinary shares was made during the year. Okay, now again, what is bonus issue? Bonus issue means that they issue out shares for free to existing shareholders. Okay, this is so that investors will continue to invest with them. So 50,000 is in units, right? So the value would be 50,000 times the price per unit. So for ordinary share, you go back to your trial balance, is 50 pence each. So it's 50,000 times 50 pence, right? That will give you 25,000. So this is the one that is stated here and for your share, under your share premium, the calculation for your share premium. Okay, so these shares do not qualify for a dividend. The bonus issue is to be written off against the share premium. So this has to be deducted from the share premium. Basically what it means is this. They issue the share to their investors, current investors, for free. So meaning that the investors do not have to pay for the bonus issue. However, the company has to bear it. How does the company bear the value? Is by deducting or reducing the amount from their share premium. So that's what happens here in number 7. At the bottom here, you can see I put an asterisk there beside it. Okay, so share premium, they minus out the bonus issue from the share premium amount as well. So their share premium will only be 20,000 after deducting both preliminary expenses and bonus issue. Okay, let's look at the answer. Yeah, so we have our SOPL, statement of profit and loss, and statement of financial position, which is our balance sheet. Okay, let's look at SOPL first. So for SOPL, we start off with our gross profit. And the reason why we start with our gross profit, as I've mentioned earlier, in this question, it's the trial balance has been prepared after they have prepared the trading account. So the trading account, you don't see it here in your SOPL, okay, which is the sales minus cost of goods sold. So you'll start off with your gross profit, and then you add on your revenue. So your revenue here would be the dividends on investment. So dividends on investment is the dividends that you received from your investment. Okay, so that's added on. And then you minus out all your expenses. So expenses, you would minus out advertising. So advertising, you would deduct 2,000, which is your prepaid advertising, which is meant for the 5th quarter, from your amount paid. So it will leave you with 8,000. Okay, so 10,000 minus 2,000, because 2,000 is your prepaid amount or paid in advance, which is meant for the following accounting period. Next is discount. Discount is on the debit side in your trial balance. So that will be your discount allowed. So it's under expenses. Office expenses. Here, remember, we had this 2,000 office salaries. So what you can do here, you can add on the office salaries to your office expenses. 60,000 becomes 62,000. But if, say, for instance, you want to separate it, so you'll have 60,000 office expenses, and then another one is office salaries, 2,000. Increase in FDD of 2,000, that's given in the question. So that's an expense. Depreciation, we have calculated earlier, 16 and 9,000 for fixtures and equipment and vehicles. And then interest on debentures, it has stated that debenture, the interest is 10%. So it's 10% times 100,000. Okay, you go back to the question, you can see that debenture's value is 100,000. So times 10%, you get 10,000. Okay, so that's your expense. So you minus out all your expenses, you'll get your profit before taxation, and then you minus out your tax. Tax is 25%. So 25% times 44,000, you get 11,000. You get a profit for the year, or profit after tax, 33,000. Okay, next is balance sheet. So in your balance sheet, you have your non-current assets, you have your goodwill, 10,000. Intangible, that's an intangible asset. Tangible asset will include your premises, your fixtures and equipment, and your vehicles. So fixtures and equipment and vehicles, you have to minus out the accumulated depreciation. Make sure to add on the new depreciation for the year, 16 and 9,000, to the accumulated depreciation from previous year. So you'll get the 86,000 for fixtures and equipment and 27,000 for vehicles. So minus that out, you get your net book value here. Okay, and then your long-term investment is your asset, non-current asset. You add up, you get 582,000. Okay, next is current asset. So current asset, we have our closing inventory. You take the lower amount, and then our debtors. Debtors, you have to minus out your AFDD. So AFDD here would be the new amount, the new value. So the old value was 1,000 in your trial balance. You add on the increase in AFDD of 2,000. So that becomes 3,000. So that will give you here 19,000. VAT, value added tax, is your asset. As in this question here, is on the debit side. So it's considered as an asset. Prepaid expense is for advertising, is considered as your current asset as well. Accrued revenue for dividends on investment, since you have not received the dividends yet, it will be considered as your current asset. Okay, accrued revenue. Then you add up, you minus out from your, you add up with your non-current assets. So non-current assets plus current assets, you get your total assets. Next is current liability. So current liability, we have our creditors, our bank overdraft. Bank is on the credit side in your trial balance, so it's an overdraft. Accrued expense, we have our interest on debenture. So the interest on debenture, the 10% of the 100,000 just now we've calculated, that has not been paid yet because you don't see it in your trial balance yet, which means that the amount is still accrued. So it's considered as your current liability. And then we have our office salaries that has not been paid, is accrued. Tax payable, okay, for tax, the 11,000 that we're supposed to pay this year, but as this is only charged at the end of the accounting period, so you will only be able to pay it next year. So for now, it's considered as your current liability. And then we have our debenture value, which is 100,000. That is your non-current liability. So you add up all your liabilities, minus out from your assets. Okay, you'll get 450,000. Equity, you have your preference shares, ordinary shares. So these are all given in your trial balance. So 200,000 and 175,000. Share premium, just now I've shown you the calculation. So 75,000 is the original value of share premium. you need to minus out the preliminary expenses as well as the bonus issue. Okay, because it has already mentioned that preliminary expenses and bonus issue will be deducted from the share premium. So that will leave you with 20,000 share premium. Revaluation reserve, there was an increase of 15,000 in the premises. Okay, so therefore you record here as 15,000. So coming back to your premises in your non-current assets, as you can see here, we recorded at the new value 295,000, not the cost price, which is 280,000. Okay, so the additional 15,000 you record it here under your equity. And then we have our retained profit. So our retained profit, as has been mentioned before, we would take the profit for the year, 33,000. There's a formula, right? 33,000, and then plus 25,000, the profit from last year. This you get it from your trial balance, minus the dividends paid. So dividends paid, there's two in this case here. There's the 8,000 and the 10,000. One is for the preference shares, one is for the ordinary share. You get this from your trial balance as well. So that will leave you with 40,000 retained profit. So you add up all your equity, you get 450,000 as well. So as you can see here, your net assets and your equity must be equal. If it's not equal, there's something wrong with your answer. Okay, so I hope it's clear. You can try out the other question. There's two, if I'm not mistaken, there's two SQA questions that you need to work out. So here I've explained to you. The other one, I will give you the workings so that you can start off your SOPL and SOFP. Okay, with that, thank you very much.